Hi student, today we will discuss question number 1 from the valuation of shares. In previous slide or previous session we discussed about the theoretical part of valuation of shares, why it is necessary and need of valuation share as well as some methods to calculate the valuation of shares. Today we will discuss one method of calculation of valuation of shares. So this is the question number 1. It explains some points. Let's see what are the requirement of your questions. Financial statement of Nakoda Limited, Nandgaon, disclose the following facts about balance sheet. Balance sheet as on 31st March 2019. Issued share capital. Issued and paid up share capital. 2000 equity share of rupees 10 each, rupees 2 lakh. 1008% preference share of rupees 100 each, 1 lakh. There is general reserve, business profit, proposed preference dividend, trade creditor, bills payable, rent payable. These are your liabilities. On asset side, goodwill 25,000, plant 1,60,000, stock in trade 80,000, fixture 5,000, book dates 1,25,000, bank balance 4,000, and underwriter commission 1,000. In this way, there is a balance sheet. Now we discuss with the some adjustments. For the purpose of valuation of shares of the company, the assets were revalued as follows. Goodwill is valued at rupees 15,000. Plant is undervalued by rupees 15,000 and stock is overvalued by rupees 10,000. You are required to calculate intrinsic value of each equity share. So when we discuss the intrinsic value of each equity share, this is the method number 1 to calculate the valuation of shares. In this heading, we calculate or we use 3 steps. Let's see what are the three steps. Okay, now let's start with the solution. In side by side we solve it because it gives the idea about how to record our transaction, how to calculate our three headings. So as a requirement of your question, you have to calculate 3 steps. Step number 1, calculating net asset. Second, calculation of funds available to equity shareholders, and third, that is the intrinsic value of each equity share as per the intrinsic value method. So in this method, according to this, first we have to calculate step number 1. So in this heading, we need to calculate or consider assets from your adjustment. So whatever the asset are there, it is recorded at a releasable value. Releasable value, you can say whatever the assets sold or released in the market, or you can also say market value or releasable value are recorded from your adjustment. There are few assets are recorded in the adjustment. That is, the goodwill is to be valued at 15,000. Plant is undervalued by rupees 15,000. Stock is overvalued by rupees 10,000. But there are more than 3 assets available or present in your balance sheet. So let's start how to consider and calculate your amounts of your assets. So the first heading, that is your goodwill. Goodwill valuation, make sure whatever the amounts are there, it is considered from your adjustment or releasable value, should be recorded for the calculation of your net asset. So goodwill rupees 15,000. Then plant, what is the amount of plant in your balance sheet? In your balance sheet, that is the book value gives you the 1,60,000. 1,60,000, but plant is undervalued by rupees 15,000, which is mentioned in your adjustment. While we discussing such type of heading, when the undervaluation of assets are there, this amount is always added in your book value. So the 1,60,000 plus 15,000. So the answer will be 1,75,000. 1,75,000, that is the undervaluation. Make sure undervaluation, only the undervalued amount is mentioned. You have to add that amount in your balance sheet. Undervaluation is always added in the book value. Then stock in trade. Stock in trade. In adjustment, stock is overvalued by rupees 10,000. So make sure what are the amount of your balance sheet. It must be reduced. Overvaluation must be reduced from the book value. So what is your book value? Book value 80,000 minus 10,000. So as per this adjustment, 10,000 must be reduced from your stock amount, and amount whatever the amount recorded for the heading, that is 70,000. So valuation of stock as per your adjustment, that is rupees 70,000. But what about the other asset? When the any or whatever the adjustment is not mentioned for a particular assets or assets, it should be considered at a book value except underwriter commission or any fixed asset. Fixed asset does not consider for the calculation of net asset. Next asset, that is the fixture. Make sure the amount or the adjustment is not mentioned for the fixed asset or intangible asset or any asset. So you can consider it from the book value or from balance sheet, but make sure it is not fixed asset. Fixed asset are not considered for the calculation of net asset. So the fixture, book dates and bank balance consider from your adjustment balance sheet, because there is no valuation for the bank balance and book dates, or there is no calculation for the adjustment. So you can consider the valuation of other asset from your book, that is your balance sheet. Fixture, book dates are considered from the balance sheet value or for the valuation of balance sheet. Now total of A, that is the total of all asset, release or releasable value of asset, that is 3,94,000. 3,94,000. Now reduce liabilities, less liabilities. So make sure in this calculation you will be calculate only current liability. Current liability in your question, not fixed liability but the current liability. Trade creditors, bills payable and rent payable is your current liability for this calculation. Make sure only current liability is considered for the calculation of net asset. Creditors, bills payable, rent payable is current liability. Creditors 35,000, bills payable 15,000 and rent payable 2,000, that is the liabilities will be reduced from your asset. So the total asset 3,94,000 minus whatever the total amount 35,000, 15,000 and 2,000. 52,000 total. 52,000 of your current liability. Then net asset is equal to A minus B. A minus B, answer will be 3,94,000 minus 52,000, 3,42,000. This is your calculation number 1 or the step number 1. Step number 1 will be calculated with the help of net asset valuation, goodwill or assets from your releasable value of assets, means assets from your adjustment, less liabilities. Only current liabilities are considered for the calculation of net asset. So the A minus B, that is the total asset minus only current liability, 3,42,000 is net asset. Then we calculate step number 2, calculation of funds available to shareholder. Step number 2, calculation of funds available to shareholder. So in this calculation we have to calculate funds available to shareholder with help of net asset That is 3,42,000 calculated in working note number 1. 3,42,000 less preference share capital present in your question. Make sure, is there any preference share capital? Yes. 1,008% preference share of rupees 100 each. 1,008% preference share of 100 is rupees 1 lakh, as well as there is one adjustment proposed preference dividend also recorded here, rupees 8,000. So both are reduced from this heading. 8% 8% preference share capital rupees 1 lakh and preference dividend rupees 8,000, rupees 1 lakh, and second point, preference dividend. Preference share dividend rupees 8,000. So 3 lakh 3,42,000 minus 1 lakh 8,000. The amount will be 2,34,000 funds available. That is the funds available to shareholder. Equity shareholders. So the answer is 2,34,000 funds available to equity shareholders. By this way, we calculate step number 2 for the next process or the calculating of intrinsic value. And then now we calculate the last point, that is intrinsic value. It is just the use of formula. So the third point or the formula is intrinsic value of each equity share is equal to, I am not putting equal sign. Intrinsic value is equal to funds available to equity shareholders divides by total number of equity shares. So this is the formula. Funds available to equity shareholders divided by number of equity shares available in your balance sheet. So find out the funds available, that is 2,34,000. That is your answer for calculation number 1. 2,34,000 divides by number of equity shares. Take number of equity share mentioned in your question, that is rupees, that is 2,000 equity share of 10 each. The number of equity share mentioned in your question. So 2,000 equity shares of rupees 10 each. 2,000 is number of equity shares. 2,000, 2,34,000 divided by 2,000 number of equity shares. So answer for this is rupees 11.70. So by this way, intrinsic value is equal to rupees